Getting a loan in the United States can feel like trying to solve a financial maze full of jargon, requirements, and invisible thresholds that determine who gets approved and who gets rejected. But the truth is, the lending system isn't mysterious. It's mathematical, behavioral, and deeply strategic. Once you understand how lenders think, you stop applying for loans and start qualifying for them. The first thing most people get wrong is thinking that loans are about need. They're not. They're about trust. A bank, lender, or financial institution doesn't care about your story, it cares about your numbers. Your credit score, your debt-to-income ratio, your repayment history, and your financial stability. If those numbers tell a story of reliability, you win. If they tell a story of risk, you're out before you begin. So let's decode the process, step by step. Your journey starts long before you fill out an application. It starts with your credit profile. In the US, this is the heartbeat of your borrowing power. Your FICO score, usually ranging from 300 to 850, determines the quality of loans available to you. The higher the score, the lower the interest rate, and the better the terms. A score above 700 opens most mainstream doors. Above 760, you're considered elite credit. But if your score isn't there yet, don't panic. Credit isn't static, it's a behavior tracker. 3 months of smart activity can improve it dramatically. Always pay bills on time, keep your credit utilization under 30%, and never close old accounts unless necessary. These 3 actions alone can add dozens of points within a quarter. Now, let's talk about loan types, because the strategy depends on the category. If you're pursuing a personal loan, lenders focus primarily on your credit score, income stability, and debt-to-income ratio (DTI). Ideally, your DTI should be below 36%, meaning your total debt payments shouldn't exceed 36% of your gross monthly income. A stable job and consistent cash flow make you a low-risk borrower, and that's what banks reward. If you're going after a business loan, the equation changes. Lenders now assess both personal and business creditworthiness. They look at your business plan, cash flow statements, revenue projections, and collateral. For new entrepreneurs, this can be tricky, so the U.S. Small Business Administration (SBA) becomes your best ally. SBA-backed loans, like the 7A program, are designed to support small businesses that lack traditional collateral. These loans offer lower rates and longer repayment terms because the government guarantees a portion of the risk. The SBA isn't the only route, though. Modern entrepreneurs now leverage alternative lenders' online platforms like Kabbage, Fundera, or Bluevine, which use digital underwriting models. These platforms often look beyond credit scores and assess business health through sales history, transaction volume, and online reputation. They can approve loans in days, not weeks, though interest rates can be slightly higher. If you're seeking a mortgage loan, then the key lies in your credit history, down payment size, and debt ratios. Mortgage lenders prefer a credit score above 680, but FHA loans allow approvals as low as 580 with strong compensating factors. The golden rule: the more money you put down, the more negotiating power you gain. A 20% down payment often eliminates private mortgage insurance (PMI), saving you thousands over the life of the loan. Car loans, on the other hand, are far simpler, but no less strategic. Dealers often push high-interest financing, but you can negotiate better rates by getting pre-approved from a bank or credit union first. That single step flips the power dynamic. You arrive with leverage, not dependency. Now, let's talk about the psychology of lenders. Every lender, bank, online platform, or private financier asks one silent question: can you repay? And will you repay? The can is the math, income, and debt ratio. The will is the psychology of your history of discipline. Every time you pay a bill early, maintain steady employment, or build predictable cash flow, you answer that question before they even ask. But here's the truth most borrowers never hear: getting approved for a loan is not the same as getting a good loan. Anyone can borrow money. The real skill is borrowing it cheaply. That means mastering timing. Your credit score isn't fixed. Your financial picture isn't static. and neither are lender appetites. Interest rates fluctuate with market conditions, inflation, Fed policy, and risk sentiment. Applying at the right time can mean the difference between paying 6% interest and paying 11%. So when should you apply? The ideal time is when your credit score is peaking, your debt is low, and you've had at least 6 months of consistent income. Lenders love stability. You don't need perfection, there's predictability. Let's talk documentation. Every loan process requires proof of identity, proof of income, and proof of stability. That means your ID, W-2 or 1099s, recent pay stubs, and at least 3 months of bank statements. For business loans, add tax returns, P&L statements, and business registration documents. Organized borrowers move faster through underwriting than time, and finance is opportunity. Now for a professional secret, pre-qualification is your best friend. Before submitting a full loan application, use pre-qualification tools offered by lenders. They do a soft credit check, which doesn't affect your score and show you the rates you're likely to get. This lets you shop for the best terms without damaging your credit profile. If you're denied for a loan, don't view it as failure, view it as feedback. Every rejection reveals which part of your financial profile needs work. Sometimes it's too much debt, sometimes insufficient income, and sometimes just short credit history. Focus on fixing the weak point and reapply after 90 days. Credit systems reward persistence when paired with improvement. And then there's the golden rule: never borrow emotionally. The moment you take a loan out of desperation rather than strategy, you shift from control to captivity. Loans are tools, not lifelines. Used wisely, they amplify wealth. Used impulsively, they amplify problems. Let's take a moment to differentiate between good debt and bad debt. Good debt is anything that generates value or income greater than its cost. A business loan that funds expansion, a mortgage on an appreciating property, or an education loan that raises earning potential all are forms of leverage that work for you. Bad debt is consumption-based, financing things that depreciate or vanish, like luxury goods, high-interest credit cards, or impulse spending. Here is a pro insight: the wealthiest people don't avoid debt, they master it. They borrow strategically at low interest, invest in high-yield assets, and use the difference as profit. That's called arbitrage, and it's the quiet engine behind much of modern wealth building. But with that power comes risk, especially in a volatile economy. Always stress test your finances before taking on debt. Ask yourself, if my income dropped by 20%, could I still make these payments? If the answer is no, the timing isn't right. Sustainable borrowing is about capacity, not courage. Now, let's address the ethical side of this. In a society where debt is normalized, responsible borrowing is rebellion. It is not about how much you can borrow, it is about how much you can manage. Debt used correctly can be a ladder. Used recklessly, it becomes a trap. So here's your action framework. Build credit intentionally, pay on time, keep utilization low, maintain stability. Define your loan purpose. Income generation beats consumption every time. Shop rates and pre-qualify to compare offers without damaging credit. Borrow only what you can repay even under stress. Use loans as leverage, not lifelines. In the end, loan acquisition in the USA isn't a mystery. It's a negotiation between your history and your habits. Learn how lenders think, master your financial presentation, and you'll stop asking for approvals because your numbers will speak for you. And of course, always remember, this is not financial advice. Every borrower's situation is unique. Before applying for significant loans, consult a licensed advisor or credit professional. But whatever your goals, a home, a business, or a breakthrough, use debt wisely, structure it intelligently. And make sure every borrowed dollar brings you closer to freedom, not further into chains.